Good morning, everybody in the Central Time Zone, and I guess good afternoon or almost afternoon to all of our friends on the East Coast. Appreciate you guys joining us today, and I want to welcome everyone to the First Horizon and Iberia Bank webinar about the Payroll Protection Plan in 2021. My name is Cliff Worley. I lead the payroll protection program efforts for the bank. And first thing, I want to welcome you. I want to welcome two groups coming together as one. As many of you guys know, in July of last year, we closed our mergers of equal between Iberia Bank and First Horizon. And as such, we welcome both legacy institution clients to this webinar. And so if you see the dual branded logo at the bottom right of your screen, you are in the right place. Thank you for carving out the time to spend with us, and we're happy to have you joining us. The goal is of today is for you guys to leave here not only more informed, but also better prepared for executing on the payroll protection program. So before we launch into our content, I'd like to level set the conversation, share a few pieces of information with you guys, but then also tick through a few housekeeping items. You know, look, before we start, I really want to emphasize our continued commitment to serving you, our clients, in 2021. On the screen, you're going to see three numbers, right? And this is what as an organization we did at the Payroll Protection Plan in 2020. As an organization combined, we executed for you over 32,000 PPP loans for over $4.2 billion. And those numbers are great and wonderful, but the most important number on the screen and the ones that candidly I focus on the most is the one on the right. That's 541,615. 541,615. That is the aggregate number of jobs, of your employees that you trusted with us to help serve them with the payroll protection loan in April of last year. And so we appreciate the opportunity to do that. We appreciate the opportunity to support you, your clients, and their families. And look, we understand how important PPP is to you and your business. It's not it's not just important to you, but it's important to your families. And again, more importantly, your employees and their families, and thus our communities. We very much understand that when businesses are stable and jobs are secure, that communities thrive. And so we're trying to do our part to help make sure this happens, and are truly grateful and honored to have the chance to help you through these economic uncertain times as a result of this pandemic. So thank you. Moving forward, I am joined by two panelists who you're going to hear from today. Looking left to right on your screen. The first is going to be Jeff Wagner. Jeff is a phenomenal attorney, and he's a shareholder from the law firm of Baker Donaldson. He's going to talk first. He's going to talk about PPP in 2021, what's new, what's different, how the rules are shaken out. And then after that, I'm going to kick it to Courtney Taylor. She's a teammate of mine, and she's helping me lead the PPP effort for First Horizon. Courtney is also a business banking lending product manager, so she is uniquely equipped to help us bring this product to market and to you guys. After each of them speak, we're going to pivot over to a Q&A portion of the presentation. Unfortunately, given the volume of information we're trying to communicate to you guys, and also the sheer number of individuals on the phone right now, almost 1,000, we're unable to do a live Q&A. And so when you guys registered for this event over the past few days, you guys submitted some of your Q&As. And so we've aggregated those, and we want to touch on the ones that we received the most and where you guys have the most questions. So we're going to try and tick through some of those Q&As at the end. Aside from that, two quick housekeeping items. First things first, all lines have been placed on mute. That's just out of respect for both the presenters and the fellow audience members. So you will not be able to speak on this line. There is a Q&A box on your screen. As I said, unfortunately, we will not be taking live Q&A, but if you're having audio issues or video issues or something like that, please pop in that Q&A box and let us know, and we'll work to get those resolved for you. And last, we are going to communicate a lot of information over the next hour, and I'm sure many of you are out there getting ready to take notes, and please do, but also know that we are recording this, and we are going to share the recording with you after the fact. And so if you missed something or didn't quite hear something right or want to go back and look at it in the coming days, likely early part of next week, just keep an eye out for an email from us, and we're going to send you the link to this recording so you can go back and listen to it at your leisure. And so I'll now turn it over to again, Jeff Wagner, who is a attorney and shareholder with Baker Donaldson. Jeff, you want to take us away, please?
Thanks, Cliff. It's a pleasure to be a part of this webinar. Working with both lenders and borrowers on Paycheck Protection Program issues has become a pretty significant part of my practice over the 10.5 months that the Paycheck Protection Program has been in existence. I hope that the information that I provide during my part of this presentation helps your customers understand a little bit better where the Paycheck Protection Program is and what to expect if they're just applying now for a first round loan or a second draw loan. As I mentioned, the Paycheck Protection Program has been in existence for just about 10.5 months now. It was created by Congress under the CARES Act in March of 2020. Since that time, it's been through some pretty significant changes, including running out of money once. Congress changed the program to make it more borrower-friendly a number of times, as did the SBA. The application period for the initial program expired on August 8th, and now Congress has come back and reopened the program through the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Shuttered Venues Act, enacted as part of the Consolidated Appropriations Act of 2021 at the end of last year. The Economic Aid Act, as I mentioned, reopened the application portal for borrowers for both new loans and for second loans, and has extended that period through March 31st. The Congress also funded the program with $284 billion. That includes $145 billion that was unused in the first go-around of the Paycheck Protection Program, and then approximately $139 billion of new money. So, what has changed with Paycheck Protection Program? First, and I'm going to guess this is of the greatest interest to most of the viewers on the webinar, it creates a second round of loans for especially hard-hit small businesses. These are generally referred to as second draw loans. Second, the Economic Aid Act makes certain previously ineligible entities eligible for loans. I'll discuss these newly eligible entities in a little bit more detail later. Unfortunately, for some, eligibility was also terminated with the Economic Aid Act, and I'll address those a little bit later as well. Third, it allows borrowers who return some or all of their loans in 2020 to reapply or to have the full amount of their loans restored. Fourth, and this has been a big issue for a number of borrowers, it actually creates a true variable period of 8 to 24 weeks, referred to as the covered period, for expenditure of their loan proceeds. Originally, the covered period was 8 weeks, and then it was extended to 24 weeks by Congress. The 8 to 24 week covered period gives borrowers a little bit more flexibility in when and how they spend their money. So, as I mentioned, there have been, with the Economic Aid Act, some entities that are now excluded from receiving loans. These include publicly traded businesses. If you'll remember, last spring when the Paycheck Protection Program was first rolled out, Secretary Mnuchin urged everyone to go out and apply for a loan or the money would quickly disappear. Unfortunately, this included a lot of companies that maybe did not need loans, including a number of publicly traded companies such as Ruth's Chris Steakhouse, Pork Belly, and Shake Shack. Due to the public uproar over that, Congress has eliminated eligibility for publicly traded businesses from the Paycheck Protection Program going forward. In addition, Congress has barred certain foreign-owned entities or entities with significant foreign operations from receiving a Paycheck Protection Program going forward. And these include entities that are created under the laws of the People's Republic of China or the Special Administrative District of Hong Kong, or that have significant ownership interest by entities or residents of China or Hong Kong, or that have significant operations in Hong Kong or the People's Republic of China. In addition, Congress has limited eligibility for what are generally referred to as lobbying entities that are involved in formulating public process or otherwise involved in the political machinery. It has been a long tenet of federal financial assistance that that federal financial assistance should not be used to perform lobbying activities, and so Congress has taken a prophylactic view with the next round of Paycheck Protection Program, and it's just eliminated eligibility for entities that are primarily involved in those type of activities. And finally, Congress has also removed eligibility for companies, businesses that have a controlling interest, which is defined as 20% interest or more, where that interest is owned by the president, vice president, a member of Congress, or the head of any executive agency, or any of their spouses. Some of you that have already applied for forgiveness may have received a questionnaire about ownership by any of these individuals. To our understanding at this point, that is only being used to gather interest for potential ethics issues for those particular federally related individuals, and not as a problem with respect to forgiveness for a loan. So, what has changed with Paycheck Protection Program forgiveness? First of all, it makes additional expenditures eligible for forgiveness. These expenditures include increasing availability for money to be used for things such as operating expenditures. These would be things such as money for payroll costs, for tracking payroll costs, for software, for general operations of the business. In addition, additional expenditures that would be eligible for forgiveness include covered supplier costs. Those would be costs, for example, for retail businesses that need to acquire inventory, or for restaurants that need to acquire supplies to produce food and so forth. It also makes eligible items for worker protection, and these include everything from personal protective equipment to actually making physical changes to facilities, such as including building sneeze guards or installing drive-through windows or so forth, to eliminate or limit contact between customers and workers. In addition, funds are eligible for forgiveness, loans are forgiven to the extent that they are used for what are referred to as covered property damage. And that is, of course, damage that resulted from the civil unrest during the summer of 2020 that was not covered by insurance. In addition, the Economic Aid Act required the SBA to develop a simplified forgiveness process and application for Paycheck Protection Program loans of $150,000 or less. This is a mandated one-page forgiveness application. It's very simple for borrowers to fill out. It does not require any supporting information to be submitted with the application itself. It is all self-certified by the borrower that it has used the funds the way they were supposed to be used, and it does, however, require that the borrower maintain records for payroll expenditures for 4 years and all other expenditures for 3 years, and to provide those upon request by the lender or the SBA. However, it is again a very streamlined process that we think many borrowers will benefit from. In addition, Congress has required that SBA make it available for individuals who have already submitted a forgiveness application that has not been acted upon to request their lenders to withdraw that application and use the more simplified form going forward. And there may be additional reasons for doing that I'll go into shortly. And then finally, and this is a big one, it was a little bit of a nasty surprise for a number of borrowers who applied for forgiveness and had actually received what is referred to as an economic injury disaster loan emergency advance, that they did not receive full forgiveness, that their forgiveness was reduced by the amount of the emergency advance that they may have received. Congress has come back and said, no, that is not what we intended. We intended those $10,000 emergency advances to be fully forgivable, to not count against Paycheck Protection Program forgiveness, and also directed the SBA to develop procedures for anyone who has received forgiveness but did not receive the benefit of having the emergency advance not counted against forgiveness to refund those funds to the lenders, and then lenders will, of course, be refunding those to the borrowers. So, what has not changed with the Paycheck Protection Program? First of all, it remains a 100% guaranteed loan program by the SBA. And this is important because these are loans that are being made by lenders with their own funds and guaranteed by the SBA. Most lenders would not be too anxious to make loans at 1% without collateral, without personal guarantees, without the SBA guarantee. And so again, the 100% guarantee by the SBA remains in place. There are no guarantee fees. Just as with the first round, all guarantee fees have been waived for the program, and this is a significant savings for borrowers. Guarantee fees on an SBA loan can be as high as 3.5%. In addition, there are no lender fees that are paid by the borrower. There's no commitment fee, underwriting fee, origination fee, documentation fee, or anything like that. Lenders are compensated by the SBA for making these loans, and the borrower does not have to pay the lender any fees. As I mentioned, there also are no personal guarantees and no collateral requirements for these loans. Of course, borrowers still have to comply with some of the core requirements of the program, and these include that 60% of the forgiven amount must continue to be used for payroll costs. Second, the business must have been in business on February 15, 2020, that is, at the beginning of the COVID pandemic, in order to qualify. And finally, they must still be able to certify in good faith that due to economic uncertainty, the loan is necessary to support the ongoing operations of the applicant. A couple of additional changes that were made by Congress as part of the Consolidated Appropriations Act that may affect Paycheck Protection Program borrowers. First of all, and Congress has come back and clarified, this was part of the original CARES Act, but it was kind of muddled in some pronouncements by some other agencies that Paycheck Protection Program loan may not be excluded from income tax for certain purposes. Congress has come back and said, absolutely, Paycheck Protection Program loans that are forgiven are excluded from income for all tax purposes. As kind of corollary, the Internal Revenue Service, interpreting an existing Internal Revenue Code provision, said that if a loan was forgiven, any expenditures made by the borrower with the forgiven loan funds would not be deductible for tax purposes. Congress, with the Economic Aid Act, came back and said, no, again, that is not what we intended. We intend that even if a Paycheck Protection Program loan is fully forgiven, that any expenditures made by a borrower with those funds would also be deductible on their tax returns. And finally, Congress indicated that EIDL, the emergency advances of up to $10,000, are not included in income for tax purposes. And finally, something that kind of flew under a lot of people's radar for a long time was the Employee Retention Tax Credit. The Employee Retention Tax Credit provides a tax credit equal to a portion of wages paid to employees of particularly hard-hit businesses that expired at the end of last year. It has been extended through the first half of 2021, and most importantly, the eligibility requirements have been eased a good bit. As originally enacted, any borrower who received forgiveness on a Paycheck Protection Program could not also take advantage of the Employee Retention Tax Credit. Congress has changed that to allow any Paycheck Protection Program borrower to utilize the Employee Retention Tax Credit if they otherwise meet the requirements to the extent of wages that are not paid with PPP loan proceeds. So I mentioned earlier some of the expanded eligible expenses, and these are, again, the eligible operating costs, the covered operating costs such as business software, cloud computing costs, payroll services, and payroll tracking costs. In addition, eligible expenses include the covered property damage costs that are not insured, and these are, again, from civil unrest during 2020, covered supplier costs for inventory and materials, supplies for restaurants and so forth. There are some limitations on non-perishable items as to when they were acquired or under contracts under which they may have been acquired. Also, worker protection costs, and these include everything from PPE to actual physical changes to the building, to buildings or other facilities used by workers or employers. And then also kind of a small change, but I think one that works with some of the changes that SBA had made in construing benefits made available to employees, and that is that the employer portion of a group life insurance premium is now considered an eligible expenditure and is considered a part of payroll costs and is eligible for forgiveness. As I mentioned, the Economic Aid Act makes a couple of new types of entities eligible for Paycheck Protection Program loans. And these include 501c6 organizations. 501c6 organizations are typically nonprofits that are organized as chambers of commerce or business leagues or things like that. The Economic Aid Act also makes housing cooperatives eligible for Paycheck Protection Program loans. Housing cooperatives are not particularly common in the bank's footprint. They are much more common in heavily populated areas such as the Northeast. And although similar to condominium associations have not been made eligible, nor have homeowners associations. Additionally, Congress has made destination marketing companies or entities eligible. Destination marketing entities are typically things such as convention and visitors bureaus, and these can either be organized as nonprofit corporations or actually as kind of quasi-governmental entities. Then finally, Congress has made news and media organizations eligible. During the first round of the program, they were generally viewed as being ineligible due to affiliation issues. Congress has now made them eligible with certain requirements on the use of the funds for local news, local emergency information, pandemic news, and so forth. And finally, Congress created a potential opportunity for insolvent borrowers, those in bankruptcy, to apply for a Paycheck Protection Program, or to allow the trustee in bankruptcy or debtor in possession to apply upon the occurrence of certain events. And the first of those is that the SBA has to determine that the bankrupt entities are generally eligible under SBA loans. And it actually requires a certification from the SBA administrator to the U.S. Office of the Trustee, indicating that the SBA will accept loan applications from these types of borrowers. The SBA has taken a pretty strong position throughout the Paycheck Protection Program that bankrupt applicants are not eligible, so I do not expect to see that certification anytime soon. And in fact, in the most recent regulations issued by the SBA after the Economic Aid Act, SBA has again maintained that insolvent or bankrupt borrowers will not be eligible for Paycheck Protection Program loans. And so now on to what I think most of y'all are probably most interested in, and that is the second draw loans. And these are second loans made available to borrowers who have already received a loan under the Paycheck Protection Program, but who have been especially hard hit by the pandemic. There are a number of requirements to qualify for a second draw loan. These are intended to benefit the hardest hit businesses from the pandemic. And one of the major requirements is that the borrower must be able to show a reduction in gross receipts from 2019 through to 2020. And that reduction in gross receipts can either be measured on a quarter-by-quarter basis, first quarter 2019 versus first quarter 2020, for example, or for the whole year 2019 to 2020. There are special rules for comparing gross receipts for entities that were not in business all of 2019 that allow some flexibility in comparing quarters. But generally, it's going to be a quarter-to-quarter or year-to-year comparison from 2019 to 2020. And if the business cannot show that 25% reduction in gross receipts, it will not be eligible. For borrowers of $150,000 or less, this certification of reduction in gross receipts is a self-certification. The borrower does not have to provide any documentation to support their claim at the time of submitting the application for the second draw loan. And in fact, will probably benefit from not submitting any information to support their claim at the time of application. Congress acknowledged that most borrowers of $150,000 or less will probably be smaller businesses without having all of the capability of providing up-to-date financial information on a regular basis to be able to show this reduction. So they wanted to be able to allow these smaller borrowers to use their tax returns to show the reduction in gross receipts, which makes the process quicker and easier for those types of entities. The loans are limited to borrowers with 300 employees or less. If you'll remember, in the first round, it was 500 employees or less. There is an exception for affiliation for entities in the hospitality industry. Those are that have an NAICS code starting with 72. Those would generally be hotels and restaurants. And there are also exceptions for those entities that have no more than 300 employees at any one location. And then, again, as a requirement to receiving a second draw loan, the borrower must have had a first draw loan. If it did not have a first draw loan, of course, it can go back and get a first draw loan now, and the requirements are actually a little easier to get the first draw loan, and the eligibility is a little bit broader. But anyway, you must have a first draw loan. It does not have to be forgiven at the time of application for the second draw loan, but it must be fully expended by the time the borrower receives the second draw loan proceeds. So a couple of details on the second draw loans. As with the first draw loans, for most borrowers, the amount of the loan will be 2.5 times average monthly payroll cost. For those businesses in the hospitality industry, again, generally hotels and restaurants, the multiplier has been changed, and it is actually 3.5 times average monthly payroll, out of respect to the fact that these businesses have probably been the most hard hit through the pandemic. The maximum loan amount for second draw loans is lower than for first draw loans. The maximum for a second draw loan is $2 million, whereas for a second draw loan, it's $10 million. Also, the limits for loans to a corporate group of entities has been reduced from $20 million for first draw loans to $4 million for second draw loans. A little bit of a benefit here for borrowers is that borrowers can generally select either 2019 or 2020 for use for payroll for determining the amount of loan eligibility, whichever one would best suit them. If they had higher payroll in 2020 than 2019, they may want to use 2020, or vice versa. Some borrowers, mainly all of those except for sole proprietors, can also use a trailing 12 months average monthly payroll, although the SBA has at least kind of implied that it's discouraging use of that method in some of the the regulations that they've issued. And finally, there are special rules for seasonal employers, those that are where the business is concentrated in 6 months or so or less of the year, and then for businesses that had not been in existence for all of 2019. So a couple more items to note as part of the Paycheck Protection Program. And I've noticed during some of the questions that have come up in the Q&A that unfortunately we won't be able to get to, but maybe some of this will help. A number of people have asked, do I have to apply for forgiveness first on my first draw loan before I get my second? Does it have to be granted? And the answer is no. You do not have to apply for forgiveness on your first draw loan before you get the second draw loan. And in fact, if a borrower applies for forgiveness on his first draw loan and then applies for a second draw loan, the second draw loan application will be held while the SBA reviews the forgiveness application. So, as I mentioned earlier, there is a new application form for smaller borrowers for forgiveness. If you've already submitted an application, you may want to have your initial application for forgiveness withdrawn and resubmit the new one, which should work a little more quickly, or just ask the lender to not process your application for forgiveness at this time, or at least until you get your second draw loan. Second, the SBA has been much more explicit on the supporting documentation required in many cases for both first and second draw loans. The SBA has been very, very clear that it felt rushed in getting the Paycheck Protection Program out and on the street last spring, and there were many things that the SBA would have required if it had a little bit more time to put the program together. Those are kind of being carried out now with this second round of loans where the documentation on payroll, the documentation for forgiveness, the documentation for showing gross receipts, et cetera, is all much more specific from the SBA. And the SBA has actually put out a lot of guidance that provides both borrowers and lenders good information on how these numbers should all be calculated. Something that has not been publicized much by the SBA is that they are conducting borrower reviews for second draw loans prior to assigning a loan number. The second draw loans are being processed through a portal that is run by a third-party vendor, and the SBA has tasked the vendor with actually running borrower names, taxpayer ID numbers, Social Security numbers, so forth, and also the same information on principals of the borrower through these various databases to make sure that the entities actually exist and there isn't any bad information out there, such as the borrower having declared bankruptcy or an owner having died or anything like that. The problem is that they are getting a lot of false hits on these database searches. So just be aware that you may, once you submit an application, you may very well get a call or an email from your banker saying, hey, we've got a little issue we need to clear up with the SBA. The SBA has acknowledged that this isn't a problem and that they are working through the issues as quickly as they can. And finally, the guidance that the SBA has issued for this round of loans, both first and second draw, is much better than what we saw last spring. They very quickly hit the streets with two sets of regulations, one which was kind of a consolidated recapitulation of regulations for first draw loans and then a new regulation for second draw loans. They have issued guidance on how to actually calculate loans that's very detailed, eligible amounts for loans, how to calculate reductions in gross receipts. It's all very detailed. It's available on the SBA website, the Treasury website, but there is still more guidance that we expect to see and we'll need to see. For example, we expect to see a little bit more guidance on forgiveness issues. The Economic Aid Act requires that second draw loans be forgivable as the same as first draw loans. There are a few questions out there about things such as reductions in full-time equivalents, reductions in wages, so forth, that have not been addressed yet. And so we expect a little bit more guidance on those issues. And now, having concluded my part of the presentation, I will turn it over to Courtney Taylor to talk to you a little bit about applying for a Paycheck Protection Program loan.
Thank you, Jeff. So good afternoon, everyone. We are extremely excited this round of originations to be able to offer a platform that allows for a truly self-serve experience for our businesses. And the platform itself is extremely user-friendly. It is dynamic throughout the process so that it allows you, as you're answering the questions on screen, it will adjust and, of course, pre-fill the application so that it is specific to your situation and specific to your business. Now, one of the things that we've realized in this process is even with the extreme intuitiveness of the platform this round, there was still a large need to have additional documents in addition to the application process for us to be able to provide to you as the businesses, to be able to assist you along the way through the application process and to be able to capture the data points needed. So one of those documents that I wanted to speak to you about today is the supplemental application. So the supplemental application is truly your guide throughout the application process. This document is essentially a workbook. It's an Excel workbook. There's many tabs. It is extremely user-friendly. So it might seem a little intense or intimidating at the onset, but what the workbook is intended to do is to be able to provide additional information for you specific to your situation so that you can better understand exactly what documentation is required for your business type and for this specific request, whether it's a first draw loan or a second draw loan. So this was such a large item that was causing a lot of confusion, because it is confusing, that we wanted to be able to provide a workbook that would allow the businesses and yourselves as borrowers the ability to go through and really understand exactly what is required for your situation. So this workbook is designed to do that. It also goes through and helps to explain better what you would need to provide, whether or not you have employees. So again, it's almost like a documentation checklist, and it caters specifically to your situation based on some answers to some questions that are asked of you throughout the workbook. What you're also going to see on this next slide that it also covers for you is it helps to also walk you through how to calculate your average monthly payroll. It does provide you the information needed and walks you through that calculation. It also works with you with the NAICS code, the NAICS code, as Jeff mentioned previously. Obviously, there is a difference between the NAICS code as to whether you are in the hospitality industry or not. So it does provide some guidance within the workbook with that specifically as well. And additionally, it goes through and helps to clarify a number of other points, whether you have affiliates, new entities, seasonal businesses, and certainly how to calculate changes in your gross receipts. So this workbook, again, is intended to provide you as much information and data as possible so that you can come to the answers and the appropriate data points that are unique to your situation and unique to your request, whether that be a first draw loan or a second draw loan. Now, additionally, there are some additional documents that we have put together to help support you throughout the process. So one thing that we know is with all of this information, with the supplemental application that I just mentioned, with our online portal, there's a lot of stuff. There's a lot of different requirements. So we wanted to be able to provide as much information and user-friendly guides to be able to walk you through the process. So the first thing that we put together is what we call our loan application user guide. It is a step-by-step workbook or guide that takes you through that online application experience. So separate and apart from the supplemental application that we just spoke about, of course, you do have that online application platform that you can self-serve. You can log in, you'll authenticate in, and you'll follow through the dynamic questions. And this guide will walk you through that process. It talks to you about the authentication process. It talks to you about different screenshots, what they mean, tips and tricks, what to enter into this field, and just gives you that additional guidance as you go through that online experience. So also, I've spoken already about that supplemental application, but what I wanted to also touch on is what that supplemental application also does for you is throughout it, based on your entity type, there are tabs that are specific to your business, and it provides a very robust documentation checklist. So as you can see on the screen, it will have a tab for, say, corporations and nonprofits, partnerships, seasonal businesses, etc. And you can navigate to that tab specifically and actually complete an on-screen document checklist, and you can even denote which ones that are required that you've provided and gathered, and it just helps you along the way to help not only with your own organization, but also with clarity around specifically what documentations are needed or required. Now, again, knowing there's so much information involved, there's so much to know for this process, we also wanted to be able to provide assistance for you along the way. So we wanted to call out there are 2 different ways you can actually come to us for assistance, even after you're using these guides, so that we can help to clarify anything in addition. So the first thing that we're offering is the ability for you to be able to schedule an appointment. We recognize that a lot of times it's not convenient for you to call in at that moment and wait on hold. And so we wanted to be able to provide an ability for you to be able to schedule an appointment so that you can choose a time that works for your schedule and someone would call you back at that time. Now, we do also offer the phone option. So like I spoke of, you could always call at any time. We've actually set up a separate phone line, and you can see that phone number on screen, that is dedicated to PPP questions. So 2 different ways to be able to contact us throughout the process should you need any assistance at all. So now I'm going to turn this back over to my colleague Cliff Worley for him to be able to open up a Q&A session.
Great. Thanks, Courtney. Appreciate it. So guys, we're gonna pivot here now into the question and answer segment of the presentation today. I'll remind you what I said at the onset. These, when you guys registered for this presentation, we asked you if you had any questions, and we read those, aggregated those, and we've put those together in some of the most common questions and topics, and we're gonna tick through those for you guys. So we're gonna kick it to the first few questions are going to be for Jeff. So, Jeff, you talked a whole lot about one of the main differences between the second draw loan that we're experiencing now and what we all experienced back in 2020 being this 25% decrease in either revenues or gross receipts or profit and loss. But if you look at the numbers, the largest number of borrowers are going to be less than $150,000, right? So, Jeff, tell me, if my loan is less than $150,000, talk to me about what I need to do to prove this 25% reduction in gross receipts.
Okay, Cliff, that's a good question. And what the borrower needs to do is satisfy itself for loans of $150,000 or less. It is a self-certification by the borrower at the time of application for the loan that it actually had a decrease in gross receipts, not profit, not gross revenue, not net income, but actual gross receipts. It's a little bit different number. There's been a 25% decrease at the time, from one quarter in 2019 to comparable quarter in 2020 in most cases. They do have to then be able to provide that information at the time that they apply for forgiveness of their second draw loan, or in the event for some reason there's an SBA loan review or something like that where the SBA requests for evidence of the 25% decrease. So nothing has to be submitted at the time of application. In fact, most borrowers are probably going to be better off not submitting any documentation supporting that 25% decrease at the time of loan application if their loan's under $150,000, because if they do submit it, then it does have to be reviewed by the lender and will be reviewed by the SBA, which could slow down processing of their second draw loan.
Great. Thanks, Jeff. So our next question, so here we are, Jeff, sitting February 11th, right? So just after the start of the year. And a lot of our borrowers, they've got, maybe 2019 payroll finished, but they don't have 2019 401k contributions completed yet. So how does that work? If they want to include 401k contributions but don't have it for 2020, can they use 2019 numbers? Talk to me about those that are kind of straddling the calendar fence.
Cliff, this is one of the unfortunate parts of the Paycheck Protection Program being rolled out at the beginning of the year. One of the requirements for the program is that all payroll costs be for the same period. So a borrower cannot use 2019 retirement contribution amounts and then rely on 2020 for the rest of its payroll cost components. They must be the same year. The choices are to either use 2019 for everything or to use an estimate for 2020, understanding that they may have some issues with either asking for too much or too little on their loan based on any changes that may be made when their contribution testing has been completed.
Great. So, Jeff, another question about, again, circling around this 25% gross receipts reduction calculation. So Jeff, the SBA guidance says that that first draw PPP loans that they got back in 2020 that have been forgiven, those can be noted out of kind of the gross revenue for that calculation, right? But not everyone has gotten their first draw loan forgiven. So how does that work? How do you look at first draw loans that you expect to be forgiven but are not forgiven yet?
Yes, the first round Paycheck Protection Program loans can be generally ignored by borrowers for the 25% reduction calculation. Of course, if the loan has been forgiven, Congress and the SBA have specifically stated that it will not be counted. And of course, if it is still a loan, and there is the potential for a repayment obligation, that would not be considered a part of gross receipts for the 25% reduction either, since debt is not a receipt of a business.
So Jeff, so next question around insurance benefits, right, which is part of compensation, which drives loan amount. So Jeff, tell me this. A borrower out there wants to know, can they apply with their 2019 payroll information, which they used back for their first draw, but now they want to add the insurance benefits that they spent as an employer? Can they add that to their employee compensation this time around? How does that work?
Yes, Cliff, I can. And this is actually a very good question, and it touches on a couple of different things. There were a number of borrowers that applied early in the first round of the Paycheck Protection Program that did not include some insurance costs, employer-paid insurance costs, because it was a little unclear at that time whether they were eligible or not, things like dental insurance, vision insurance, and now life insurance. They maybe did not get as much of a first draw loan as they would if they were applying for a second draw loan using that same time period, 2019, but adding in the amount of employer-paid insurance costs such as vision, dental, life insurance, and so forth. Now, the only problem with this is a borrower that applies for a second draw loan with the same lender that it used for its first draw loan and uses the same payroll information does not have to submit the supporting payroll information with its second draw loan application. However, if that information changes, for example, here, by adding the cost of the insurance benefits to the payroll information, the borrower will have to resubmit that information with the updated numbers with its second draw loan application.
Makes sense. Thanks, Jeff. So next, again, so Jeff, we've talked about it a bunch, right? We've talked about, again, what's new with the second draw loan being around these the 25. You have to be able to demonstrate a 25% reduction in gross receipts. And Courtney also talked about how First Horizon Iberia Bank, we've provided a worksheet to help our borrowers demonstrate that 25% reduction in gross receipts. But what if a borrower has their own financials, Jeff, and they want to come to the application with their own financials? Can they use that instead?
Yes, Cliff, a borrower can absolutely use its own financial statements to show the 25% reduction in gross receipts. It is specifically allowed for by the SBA regulations. There are a few requirements, namely the borrower has to annotate those financial statements to show exactly how gross receipts are being calculated from the numbers on the financial statements. Then they have to be signed, certified as being true and correct, and just to make it a little bit more difficult, every page of the financial statements then has to actually be initialed by the borrower as well. But yes, financial statements of the business are fine as long as they meet the requirements of being annotated, certified, signed, and then initialed.
Got it. All right. Thanks, Jeff. So So Jeff, we've talked a lot about borrowers with employees and their payroll expense, but let's pivot and talk about borrowers who are self-employed individuals, right? These are the folks that file Schedule Cs for their taxes. Are they still capped at that kind of annualized $100,000 number like they were last year, which would then translate into a maximum loan amount of $20,833? Or how should self-employed individuals be thinking about the borrowing amount?
Yes, Cliff, they are still capped at that same amount, same thing. Farmers and ranchers have a little bit different way of calculating their loan amounts, but they are capped as well at $20,833. Of course, these self-employed individuals, farmers who have employees as well, are also eligible to get loan funds to cover payroll costs for their employees, but for themselves, they are capped at the $20,833 for themselves.
Got it. All right. So next question, Jeff, and this is actually one we get a lot, which on the surface might seem like I'm trying to be cute here, but it's a true and genuine question. So Jeff, we talked a lot about having to show the quarterly reduction of 25%, and we talked about years. Let's talk about the definition of the word quarter and definition of the word year, right? And so is a quarter any 3 months you want? For example, can I use May, June, July? Does it have to be calendar quarter, fiscal quarter? Talk to me about the definition of the word quarter and year.
Cliff, this has raised a lot of questions. I will tell you probably the first 4 or 5 questions I got after the Economic Aid Act was rolled out was, what does quarter mean? Because it can make a huge difference for borrowers. The Economic Aid Act itself does not define quarter, does not say whether it needs to be calendar quarter or whether a borrower may use fiscal quarters or some other period. However, the SBA in their regulations has said it must be calendar quarter if the borrower is comparing quarters, or must be calendar year if they are using the full annual comparison. They cannot use fiscal quarter, cannot use, as an example here, May to July. They cannot use a rolling 12 or 13-week period, which would be basically 3 months either. It must be calendar quarter, January through March, April through June, July through September, October through December.
Got it. Thanks for clearing that up. So Jeff, if you look back to 2020 PPP, the majority of the country's borrowers were less than $150,000, right? So let's dig in on those. And so if I'm a borrower coming to apply for a PPP loan today, and I'm less than $150,000 loan, tell me about what documents I need to provide.
Okay. They actually need to provide very little documentation at this point. They're self-certifying at the time of application that they have met the reduction in gross receipts. They are relying on prior payroll costs. So there's basically just the application and supplemental application certification. They do not have to provide quarter-over-quarter data. And in fact, as I mentioned earlier, if it is provided, then the bank actually has to review it. The SBA is likely to review it, and that could cause some delays in actual funding of the loan.
Great. That's helpful. All right. Jeff, I'm going to let you go get a sip of coffee, but don't go too far. We're coming right back to you. This next question is for Courtney. So Courtney, Jeff mentioned a little bit earlier about some of the challenges that the SBA is having working with their vendor and authenticating and validating these loans. But let's level set the conversation. Let's set expectations and make sure we're being transparent. How long should this process take from application to getting your money, and what can borrowers expect in terms of timing?
Sure, and this is such a critical question. Because ultimately it comes down to when our businesses are going to receive the relief that they need. So as Jeff mentioned, this process or this round of originations is significantly different from a timing perspective than previous. And specifically because the SBA did indicate that it would be slower this round. They did change, of course, their connection or how they communicate with lenders in such a way that it has built in, as Jeff prescribed, an eligibility criteria check. So they're checking a number of different things now, and they were very upfront about the fact that it will take at least 24 to 48 hours before even being able to complete those checks along the way. So that's the very first reason why the timing process is a little bit, it could seem longer this time than previous. It also, when it does the eligibility check, so not only is it going to take that 24 to 48 hours, but as Jeff also mentioned earlier, there's a number of processing issues or errors and hold codes that are coming back that we're experiencing. Roughly about a third of our applications are coming back with one of those hold or error codes. They are looking at and comparing so many new things this time. So to give a little bit of context, they're going to be looking to the taxpayer identification number for matches or issues or mismatches. They're going to check the active status with the Secretary of State. They're comparing, if this is a second draw request, they are doing a ton of matches back to the first draw request. So they're ensuring that the tax ID number was the same, the tax ID type is the same. So there's a number of checks involved that is really creating a little bit more of a hardship and actually elongating the time in which we're getting approval back from the SBA. There's also some unresolved technical issues, as Jeff mentioned, with the current SBA PPP process and some of those error codes that are coming back. They've been very upfront about the fact that they are aware of it, and they are working very quickly on trying to alleviate a little bit of that process so that it's not going to create such a hardship or hold up for the applications that are in that pool of population. So one thing that I do want to call out is, while as we talk about these issues that we're experiencing with hold codes and error codes from that check kind of process that's involved before issuing approval, these are known issues within the SBA program as a whole. All lenders are experiencing this. This is not unique to First Horizon or Iberia Bank, it's impacting banks across the country. Regardless, we recognize that a third of our applications coming back with one of these hold codes is a large enough of a population to where we have assembled a dedicated team of resources to work through every single one of these and do as much research as we can as possible in hopes to be able to resolve this directly with the SBA, to get this back in the processing stage and be able to get that approval and those funds reserved for our businesses that need it the most. So we are extremely sensitive to the fact that we know that this is an issue and is unfortunately an issue for roughly a third of our applications. But again, this is something that the SBA is very vocal about, and that they have spoken with all lenders and banks across the country that they are working aggressively to try and figure out ways to be able to better or enhance that process to where a little of this is somewhat alleviated. So I guess the biggest thing I want to leave you with this question is know that we are definitely aware, and we are dedicating significant time and energy into all of these that do come back to be able to resolve them as quickly as possible so that we can get the relief needed to our businesses.
Awesome. Helpful, Courtney. Thank you very much. So Courtney, I'm going to throw you a little bit of a curveball. We're going to, in the interest of time, we're going to fast forward a couple of slides. And Courtney, I'm going to stick with you if that's all right. I've got a few more questions for you before we adjourn. So, okay, so I'm a borrower in the audience right now, and I've been listening for the past 58 minutes, and it's a lot, right? And I'm trying to make heads or tails of the PPP of what do I need, what do I not need. Boil it down to me, Courtney. How do I know what I need to show up to the invitation process with?
Right, and I will go back to what we spoke of earlier, the supplemental application. So again, we did create this workbook as an additional document. It is a required document. It is a document that is actually versions that are unique to first draw loans and second draw loans, because obviously the requirements are drastically different depending on whether you are coming to us for a first draw loan or a second draw loan. So that supplemental application workbook is what will tell you exactly what documents are required for your entity type and your request type.
Helpful. Thank you very much. And I'm gonna blend the last two questions together for Courtney, and you can kind of knock them out together. So let's go to the other end of the spectrum, right? Let's say I'm a borrower. I've read the 5,500-page bill from Congress. I know this thing inside and out. Do I have to use the supplemental application, right? If I feel comfortable not, do I have to use it? And then also we've got this borrower certification. Do I have to show up with that as well?
Yes, great questions. And the answer is yes to both. So even if you believe to know all of the documents that you that are required of you in your entity type, we do require both the supplemental application workbook and what is called a borrower certification document as part of every application. And we wanted to do this just to make sure that that borrowers are really thinking of every single thing, and additionally to allow for a seamless and more consistent review process on our part, so that we can get these applications through as quickly as possible. So yes, the answer to that is certainly it is a required document, as well as the borrower certification document. So the borrower certification document is an additional standalone document, but it is not a workbook. It is not something that you have to fill in fields or do any calculations. It is merely a document that lists out different certifications and disclaimers. And basically it is better explaining the relationship that the borrower, the business, is coming into with us as a lender and with us and how we are doing business with the SBA. So it is just a certification disclaimer document that we do ask that all of our borrowers complete and acknowledge, in addition to the completion of the supplemental application and the completion of the online application through our portal.
All right, Courtney, I'm going to let you off the hot seat. Look, guys, I want to bring this presentation to a close, but I want to end it the same way we started. Look, we recognize that when businesses are stable and jobs are secure, it makes our communities thrive. We feel very fortunate and privileged to do business in the communities that we do, and we take that very seriously. And so we appreciate the opportunity to support you, to support your employees, to support their families, and to support our communities. So again, this webcast is being recorded. We're gonna get that out to you. Be looking for an email on that next week. If you need more help, go to our website. We've got a robust website in terms of support for PPP, but also reach out to your banker. We want to be here. We want to be a resource for you. And so that concludes the presentation. As you guys exit this webinar, there'll be a quick little pop-up, and you get 2 pages on your screen. One is a 2-page survey. If you could quickly answer that for us, that helps us. That helps us be better to support you. And so if you could let us know what we could be doing better as relates to this WebEx, we'd appreciate that. But also, we'll be our Payroll Protection Information Center. So with that, I will conclude the webinar. Again, thank you for your business, and thank you for allowing us the opportunity to support you, your employees, and their families. Thank you.